Alright, in this video, we are going to talk about the next options grid, and the next option grid is called delta. Now, this is a very important segment. In fact, most of the options grids, they add to our increased chance of making the right decision. So let me explain to you what is delta, and then after delta, a very closely thing links to delta is gamma, which we'll be talking about in the next video. Okay, so for delta, this is the definition of delta, is the theoretical estimate of how much an option's value will change given a $1 move up or down in the underlying security. So meaning to say, if the stock price move up, how much it will move? Stock price move down, how much the options premium will move? Okay, the options value will move. So in this case, right, I want to share with you that the call for call option, the delta range from 0 to 1. And for the put option, the delta range from -1 to 0. Okay, now let me show you an example and it becomes a lot clearer. So right now here, you can see I have a meta on my platform. And in order to see delta, what we can do is click on this portion and then manage columns. In most of the brokerages, they will show you delta as well. Okay, you can actually add delta in. So this is delta. I'm going to add gamma for later example. So after this is done, we can see the delta and the gamma. You can see that delta, right now, the share price of Meta is 479.78. If the delta, or the call option is in the money, okay, when it's in the money, it's 477.5. You can see the delta is 0.67. And the further in the money, the higher the delta is, from 0.6 to 0.7, 0.8, 0.9, and almost near 1. Later, you'll understand why that's so. Okay, but for now, remember, what this means is, for example, if I'm going to click on a 477.5 strike price call. So what does this mean? It means that if I buy this particular call, it gives me the right to buy this Meta at 477.5. So going back to the charts to make it a little bit easier to explain this, let me just clear away all these drawings. Again, the share price of Meta now is 479.6. And what we are looking at is a 477.5 call option. So I'm just going to put horizontal line here. Okay, if I put at 477.5 around here, let me zoom in further. So shift this up to 477.5. All right, let's zoom in even further. 477.6. A little bit lesser, a little bit lesser. Okay, almost got it. Yes, 477.5. Let's see. Did I get it correct? 477.5. Okay, so what it means is when I buy a call option, I'm locking in the price to have the rights to buy here. So let me just put here 477.5 call. Buying gives me rights to buy Meta at 477.5. Now, right now, we can see that the share price is 479. So it's above. So what it means is, if you remember, this option here is in the money because we can buy the shares at 477.5 and sell it at 479.6. So you buy at 477, you sell at 479, you're making $2. That's right. So you have a intrinsic value of around $2. Okay, about 90 cents actually. So you can see that the delta of these options, let's take a look at the premium of these options first. So for right now, 477.5, if I click on it, buy, and if I click, you can see right here, there are the various grids. Let me just screenshot this and let's go and do some analysis together. You can see that the delta of this particular option is 67.131. You'll see what it means in a moment's time. And okay, remember that the delta of the call, this is a call option, okay? It ranges from 0 to 1. So this is 0.671. But in this particular screen, they show that it's 67.131. Okay. It's supposed to be about the same. Okay, there's a slight difference. Okay, because sometimes they take the bid and ask price. Okay, but it's supposed to be this number 0.671. Okay, actually it is the same number. Okay, multiply by 100 because it's 100 shares. So delta is 67.1. Okay, this is even more detailed. Okay, so what does it really mean? It means that the options premium, let's take a look at the options premium right now. It is 6.52. So remember this, the price right now, the share price right now is 479.78. Okay, so meta equals to 479.78. This is Meta's share price. I'm going to put META, Meta share price here. And the options value, so the call option, and in this case, we're talking about a 477.5 call option. The premium is 6.52. This is the last premium that we see, last transacted premium, 6.52. Now, we can see that the delta is 0.671. Okay, but if you multiply by 100, it's 67.1. So what it means is this: if Meta's price increase, so plus $1, which means that it becomes 480.78. So exactly increased by $1. The idea is that the call option, the premium will increase by 0.671. This is the theory, or this is the definition of delta. When the stock price increased by $1, fully $1, the option premium will increase by the delta amount. So in this case, we can see that it is 917. So it becomes $7.19 if it increased by $1. So this is the idea of delta. Now, delta, okay, it also shows us this thing. How do we use delta? Most of the time, they shows us the probability, okay, probability of how likely this option will be in the money at expiry date. What do I mean by in the money? You must understand that right now, this particular call option, 477.5, is already in the money. But we have 1 day left. Okay, for this one is 1 day left. And also Meta's price is still moving up and down. There is still a chance that it may go down. So if let's say Meta's price goes down, okay, below 477.5 here, is it 477.5? Did I put it here? Where is 477.5? Okay, I shifted it wrongly just now. Okay, somewhere around here, 477.5. If it goes down, this option becomes out of the money. So what delta shows us is that is a, let's see, there is a 67%, 67% based on normal distribution. Okay, so normal distribution is based on, of course, the volatility of Meta, how much it goes up and down, and there's a 67% it will be in the money. Okay, so you can see right here. Coming back to here, they believe that there's a, okay, not they believe, based on statistics, 67.1% that Meta share price will be above 477.5 when it expires. So meaning we say, if you take 1 minus 0.671, there's a 32.9%, so the 33%, 32.9%, that Meta will be below 477.5. If it's below 477.5, this call option will be out of the money. Okay, so in the money means that the Meta share price is still above. Out of the money, it means that Meta share price is below 477.5. Now, how is this useful to us? This is useful to us in a few scenarios. But let me give you the example that we usually use. It's okay, but before, okay, let me see. let me give you the example of how we use it. Okay, so delta's application, right? Remember, we do sell calls sometimes. So what do we mean by we sell calls? We sell calls, right, is also income strategy for options. So we buy 100 shares. So example, we buy 100 shares of Meta, okay, at let's say 440. So after buying Meta shares at 440, as the share price goes up, we can sell a call option. When we sell a call option of 477.5, it gives us income. Remember, it gives us certain amount of money. Now, if we actually do that, right, we must understand that there is a 32%. Oh no. If we actually sell a call at 477.5, there is only a 32% you'll be out of the money. Being out of the money means that at the end of the expiry date, the share price will drop. And if the share price drop, okay, below 477.5, if it really eventually drop, what happens is we still get to keep our 100 shares. So the option is out of the money and it will expire worthless. Reason being, okay, reason being, if let's say the share price is now 469, okay, not 469, okay, let's say 469, or even 470, let's say 470. If it's 470, it is below 477.5. When we sell an option, okay, in this case, remember buying an option, okay, or selling. So in this case, when we sell a 477.5, it gives us the obligation. We are selling a promise. Selling a promise to sell Meta at 477.5. Okay, so when we sell an option, in this case, the example is selling, we collect the premium, which is about $600 over. So for these $600 over, we are promising that, hey, you can actually take my Meta shares. So we are promising to sell our 100 Meta shares at 477.5. So there is only a 32% it will be worthless. Meaning to say, there's a 32% at the end of the expiry, we will get to keep our shares because the share price has dropped to 470 instead of 477.5. If it's at 470, we say that, hey, you want me to sell Meta to you at 477.5? The person who got our options will say, no, thanks, I can buy it from the stock market at 470. Why should I buy it from you at 477.5? So even we try to sell them at 477.5, they will not take it. Anyway, they have the rights, they do not have the obligation. And remember, I also mentioned at the end of the expiry, it will be automated. So it's below 477.5, it's out of the money. If it's out of the money, it will not be exercised. In fact, for us, most of the time, when we buy a share that's good and we sell, the reason why we buy the shares is we believe it's going to go up, up, up. Okay, so we think it's good, and we sell an option is to get the income, hoping that it doesn't get exercised, it doesn't get sold away. We want to hold the shares for long term. In this case, we have a 32% we have a 32% chance that you will continue to keep our shares, and we have a 67% chance of losing our shares. So we don't do that. In fact, for us, when we sell a call, okay, when we sell a call, we want to look at a low delta. Low delta means, right, there's a high chance that we get to keep our shares. So how high is high? I want it to be at least 70% chance. So I'll look for a delta, okay, a delta that is below 0.3. Okay, why do I do that? So you think about it. If I have a delta, okay, in terms of delta, lesser than 0.3, what it means is there's only a 30% chance of me losing my shares. There's only a 30% chance that this option, okay, this option is a 487.5 option. Pardon me, okay, just clear this off. 487.5 options, if I sell it, okay, delta is not coming up, but we can see from here 0.29. Okay, so there's a 29% chance it will be in the money. So how does it look like on the chart? 487.5. So 487.5 is right here. 487.5. Okay, it's right here. So what this particular options is saying, okay, is the stock price must move above 487.5 for it to be in the money. Again, now let me just shift this. When we sell a 487.5, we are promising to sell our shares at 487.5. And right now we bought 100 shares at 440. This is just an example. In this case, the delta has changed, so the probability also changed. So let me just show you. The probability that it will be above 487.5 and be in the money is only 0.29. Okay, so 29%. That's a lot better, right? 29%. And for it to be in the money, out of the money. Okay, so there's a, how many percent is that? Okay, so 100 minus 30, that's 70. So we have 71%. We have a 71% chance that it's out of the money, meaning to say it doesn't go above 487.5, and therefore we still get to keep our shares. And for this trade, well, we are collecting a bit lesser money. We are collecting $185. I'm going to just take the money because I still want to keep my shares. So it's very, very important to do that. Now, this delta also changes when the stock price change. So what do I mean by that? As the share price increases, the delta also increase. So as I mentioned, when it becomes deeper in the money, for example, that case, when we look at 477.5, let's go back to here. 477.5, the delta is 0.71. Now, let me show you this. So we can see that, okay, we can see that the premium increased by 0.671 when share price increased by 1. So when it becomes 480, this particular stock, okay, this particular option at 477.5, let's go and take a look at the visually. Now, let's go back to 477.5. If the share price goes to 480, which is $1 increase. If it goes up by $1, 480 here. Okay, what it means is, right, 483, 480. Okay, it's just a little bit of an increase. Now it's already 479. So if it goes up by $1, okay, if the price increase to here, it will be deeper in the money. When it's deeper in the money, the probability of it staying in the money is even higher. So delta do change, which goes to our next options grid, which is called gamma. So I'm going to explain, in fact, I'm just going to explain gamma right now because it's a lot easier to understand when we pair it together. So let's take a look at just now something that we capture here. Now, you can see that the premium of a 477.5 core increases when Meta share price increase. When it increased by $1, it will roughly increase by 671. So this is delta. It will increase by the amount of delta. However, I want to share with you that delta, it is like the speed of this particular option price increasing. When we talk about speed, right, let me explain to you in a way. Like example, we talk about a car. So a car, for example, it's driving really fast, vroom, going in that like direction, and we have a speed camera. So if you have a speed camera, okay, and this car is like just starting out, okay, the guy got into the car. This is supposed to be the policeman, okay. So you know that my art is excellent. So this speed camera is capturing the car at this point in time. So the car is moving fast. Just started going to the car, and for the first 5 seconds, moving up. Initially is 0 kilometers per hour, okay, and then it increases to 30 kilometers per hour. Now, you know that it is accelerating, correct? But when we capture at that point in time, we can only capture the current speed at this time. So the camera shows is 30 kilometers per hour. Okay. So the 30 kilometers per hour, right, is the speed. So delta is the speed. Now let's talk about gamma. Gamma is the acceleration, is the change in speed. Because what happens is 1 second later, we know that this car is going to become 40 kilometers per hour, increasing in speed, then become 60, and then all the way to 100. So you know that some of the vehicles, right, they will actually go and measure how long it takes from, let's say, for it to become 100 kilometers per hour, it takes about 3 seconds. What is this? Is this called acceleration? The increase in speed is called acceleration, and this is known as gamma. Now I'm going to go back and show you this. We can see that the gamma right here is 3.587. So I'm just going to show you what happens, and then I'll tell you how we use gamma. So let's go back to here. And in case there's really a lot of information, don't be too worried about it. Okay, all these, right, in fact, I will just share with you how to use it, the application of it. We don't have to know the theory of it that much, okay? Okay, so example, this again. Okay, so we can see that the gamma is 0.036. Now, what does it mean? It means that the gamma is the change in delta every time the share price increase or decrease by $1. So if let's say the share price increase, the share price, which is 479.78, increased by $1, okay, the delta or the premium, okay, which is 6.59, will increase by 0.71. Now, once it increases 0.71, the delta also changes because the probability of it like becoming more in the money is even higher right now. Now it's like, okay, because 477, well, it's pretty fixed. Okay, again here, 477.5 is pretty fixed, but as the price goes higher and higher and higher, let's say it goes all the way up here, you can see it's very deep in the money. When it's very, very deep in the money, the probability of it staying in the money becomes higher and higher as the price increases. So while the premium increase, the delta also increase because the probability of it staying increases. So how do we measure or how do we use gamma? So you can see the delta right now is 0.671. So there's a 67% that this particular options will stay in the money at expiry date. But when the meta price increased by $1 to 480.78, okay, increases, we can see that the premium increase, but the delta also increased. So what happens is this: the new delta when the share price is 480.78, we can see that the new premium is 7.91, but the new delta will be 0.671 plus gamma. Gamma is here. Okay, in fact, it is easier to look at it here, this way. Gamma is 0.036. Okay, 0.036. So the new delta, okay, a projected delta will be, where's my calculator? Oops. Okay, let's draw it here. 0.671 plus gamma 0.036. Okay, so the new delta will in fact be 0.707. So what this means is when the share price increase by $1, the probability will increase from 67% to 70.7%. And the next time when delta or the share price increase by another $1 to 481.78, the premium will be 7.91, okay, 0.91 plus the new delta, which is 0.707. Okay, the premium will be projected to be 7.897. 7.897. So this is what gamma does. Now, so the greater the gamma, the greater the delta increases and the greater the premium of the stock price increase. So if you want to go for a very high volatile stocks, okay, we want to go for something that actually shifts very fast. We want to go for something that's very high gamma. Now, in the subsequent strategies, we'll be talking about gamma scalping. Okay, gamma scalping, essentially, it means that we want to actually go for stocks that moves in a very fast pace. So that it's a way for us to buy low, sell high, buy low, and we need very high gamma. That's where our options will work very well for us. At the same time, if let's say we are not a day scalper, we don't do it like stay up in the middle of the night to really trade or stay the whole day to trade. We want to do it like various days. We want to do it like, okay, every end of the day, I'll just adjust my position. We can look for very low gamma. If we want to look for extremely slow pace, okay, I want to look at my stocks every once a week. We go for extremely low gamma. So extremely low gamma means that the delta won't change a lot. So it means that the options pricing, okay, there isn't a lot to adjust because when the delta doesn't change a lot, we do not need to keep adjusting our position. This is for a little bit more advanced strategy. But right now, you must understand that when we look at delta and gamma, it shows how much the premium will change. And in the case of delta, it shows the probability. And when we sell options, it is a lot easier for us to look at the probability, whether these options will be in the money, out of the money, whether it will be exercised. So later in the subsequent like strategy segment, when we sell options for income, there will be situations where we need to adjust it. We need to roll the options Because why? The probability has changed. Initially, it's a very high probability it will become like out of the money. So it will be expire worthless. We want our options to expire worthless when we sell it. But when the probability increase, okay, from initially we have a winning chance of 70%. Okay. But however, the probability now changes. It will be in the money. The chance that you will be in the money is from 30% goes up to 40%. Means that our winning chance drops to 60%. We may choose to close the option and then sell a further weak one further away to adjust the delta, adjust the probability of us winning. I hope that this opens up your mind, opens up your eyes, and opens up your ability to actually manage your account. So super excited to explain to you more of the options Greeks and how the strategies come together. So I'll see you in the next video. We're going to talk about the last options Greek, which is called real. Okay, real is something that's very simple. It doesn't have a huge impact unless there's certain situation, which I'll explain to you in the next video. I'll see you then.